we're going to go ahead and swear in Mr. Reese, our newest member, and we'll wait to call the meeting to order until we get our, well, no, he'll be okay then. Okay.
He will make our quorum.
He'll make our
after
quorum.
he's sworn in.
We got advice from our legal counsel that we could do that.
Okay, place your left hand on the Bible, raise your right hand, and repeat after me.
Yes.
I, J.C. Reese,
I, J.C. Reese,
do solemnly swear
do solemnly swear
that I will support, obey, and defend
that I will support, obey, and defend
the Constitution of the United States
the Constitution of the United States
and the Constitution of the State of Oklahoma,
and the Constitution of the State of Oklahoma,
and that I will not knowingly receive,
and I will not knowingly receive,
directly or indirectly,
directly or indirectly,
any money or other valuable thing
any money or other valuable things
for the performance or non-performance
for the performance or non-performance
of any act or duty
of any act or duty
pertaining to my office
pertaining to my office,
other than the compensation allowed by law.
other than the compensation allowed by law.
I further swear
I further swear
that I will faithfully discharge my duties
that I will faithfully discharge my duties
as a member of the Oklahoma City Employee Retirement System Board
as a member of the Oklahoma City Retirement System Board
to the best of my ability.
to the best of my ability.
Congratulations.
Thank you very much. I appreciate it.
Okay, before I call the meeting to order, I'm going to just let everybody know that I worked for 26 years with J.C. when I was in the Public Works Department, and I have nothing but the highest regard for his integrity and his abilities, but I'm just going to let everybody know that when I first heard that he was going to be on the board, I was extremely happy for him, but then I kind of got nervous for about that month, for about 2 or 3 seconds, because now, I don't know if you all know this, but now we have 2 members on the board from Caddo County, Oklahoma. Mr. Bryant is from Carnegie, and Mr. Reese is from Apache, so I will take it upon myself to give an extra level of attention to their behavior and report out as necessary of any improprieties I found, because I've been to Caddo County several times in my life on hunting and fishing expeditions, and it's a nice place, but you always got to keep one eye open. So anyway, with that, we will call the meeting of February 13th to order. Item number 4 on our agenda.
We do need to receive.
Oh, I'm sorry. Item number 2 is to receive the special election report. Have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item number 4 is to approve the minutes of the meeting of January 9th, 2020. Have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item number 5 is to ratify approval. We have 3 items. We can take them together. Have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item number 6 is to approve the claims docket. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to approve the following applications for service retirement. We have 7 applications this month. I have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item number 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. I have a motion and a second on item 8. All in favor? All opposed? Motion carries. Item 9 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. I have a motion and a second on item 9. All in favor? All opposed? Motion carries. Item number 10 is to receive the report of death, authorize Secretary to make necessary changes to conform on the following. I have a motion and a second on item 10. All in favor? Aye. All opposed? Motion carries. Item number 11 is approve the following applications of vested rights.
Move the item. Second.
I have a motion and a second on item 11. All in favor? All opposed? Motion carries. Item number 12 is to approve the request of the following to terminate vested rights and commence retirement benefits.
Move the item. Second.
I have a motion and a second on item 12. All in favor? All opposed? Motion carries. With the pleasure of the board, what I'd like to do is to move the revised item number 13, which is the presentation by Louise on the assumption study. I'd like to go ahead and take care of items on number 15A through D first, and then invite Louise up to do her presentation, and then we could finish up with items E through J on item K. Oh, I'm sorry. With item K, just so her report is immediately followed by the recommendations that are on the agenda. So with the pleasure of the board, let's do that. Jumping down to item number 15, items for individual consideration. Item 15A is to grant a cost of living adjustment to eligible retirees effective January 1st, 2020. In your packet, we received from Renee that the CPI was 2.3% over the last 12 months. Our policy states that we have a max of 2%. So I'll entertain a motion to grant that COLA for the eligible retirees. I have a motion and a second on item 15A. All in favor?
Do we need to specify the rate?
Yeah.
Yeah, JC, your motion was for what percent?
0.3.
No.
No, 0.2. I'm sorry, 2%.
There's a motion on the floor to approve a 2% COLA for the eligible retirees. Have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item B is authorize a reallocation of funds from K2 White Elm Capital / Mauna Kea platform to managers on the K2 Mauna Kea platform. Jason, do you want to give us just a little bit of information on this, just to refresh everybody's memory?
Yep. You have a handout that says reallocation, or K2 Mauna Kea platform reallocation recommendation.
Right.
So this is your long-short equity hedged component. As you know, we transitioned from a commingled fund of funds managed by K2 to this platform, which K2 is the advisor. However, you have the ability to customize your allocation to the underlying funds. White Elm, one of the underlying funds on this platform, decided to close up shop at the end of the year. Not because of anything wrong. The principal portfolio manager has been very successful. He decided he only wanted to manage his own personal wealth and not outside investors. So your investment in White Elm was distributed back to you in January. You'll see on page 1 of this, it was $7.8 million. You had $7.8 million invested in White Elm. That was returned in January, less a 5% holdback. On page 1, we have the recommendation as to how we're recommending that be reallocated. $1 million to, and these are all managers that you're already currently invested in, no new managers, just reallocating amongst them. $1 million to Engaged, $500,000 to South Point, $1 million to SQN, $3.9 million to Suvretta, $500,000 to Swift Current, and $500,000 to Tremblant. think just, I know that doesn't mean a lot to you all, but I think if you look at page 3, in the middle of the page, you see in the highlighted blue, the overall long, short, gross, and net exposure. What we're trying to do with this entire portfolio is have the long-term objective is return similar to the global equity markets with about 2/3 the risk. So what we're trying to do is have the allocation have somewhere between a 50 to 70% net market exposure over time. Sometimes when things are very good, the underlying managers might lean more toward the 70% net exposure. It gives you a little bit more juice to pick up upside in markets. Right now, where we are with this change, we're moving from a 60% net exposure to 58% net exposure. So still staying about the same, but we think based on where we are, valuations are very high. It's a slight move in a direction of being a little bit more conservative. That's what it would look like at the end of the day. Page 5 is simply, this is the recommendation, how to reallocate it in those dollars. This is simply, we're replicating the form that needs to be submitted to K2. It actually needs to be done tomorrow to reallocate these funds by March 1. So unless there's questions, again, these are all managers that you're already invested in, just adding money to them. We're not changing the profile, the risk profile of the overall portfolio.
Okay, does anybody have any additional questions for Jason on this item? If not, Chair will entertain a motion on item 15B. Have a motion to second on item 15B. All in favor? Aye. All opposed? Motion carries. Item 15C is to receive a presentation from Asset Consulting Group concerning a liquid absolute return manager and select one or more candidates to interview at a subsequent meeting.
Okay. Didn't have the agenda in front of me to see how this was all being done, so grabbing things. Maybe if you take the monthly report, just so I can give you a little bit of background. The first page of the monthly report shows the overall current target allocation, and you'll see there in the middle of the page fixed income overall. You have a 25% target allocation to fixed income. The purpose of fixed income is to provide a buffer against declines in equity markets, to provide principal preservation and liquidity in the portfolio. But as a long-term investor that needs to get north of a 7% return over time, where we are today, and I know you're going to talk about this from the actuarial side, just in looking at your discount rate and the assumed rate of return, and that has been coming down. But if we're at 1.6% on the 10-year Treasury yield, that's a pretty good indicator of what bonds are going to deliver over the next 10 years. And this has been the case for some time. So we've, within your fixed income, we've tried to do some things that will mitigate sustained low yields, like we've really seen the last 10 years, but also protect in an environment where yields go up through introducing some other return drivers. Core Plus bonds, which is the largest allocation you have, the Western portfolio, that manager has Western has the ability to take on more risk in the global bond markets when that's attractive. But they're not able to go short. They're just able to add high yield, non-U.S., some bank floating rate debt, but also when things get a little bit less attractive from a valuation standpoint, they'll take risk down quite a bit. So right now, that strategy looks like a core bond manager. It's primarily investment grade. The global bond piece, which is Brandywine, they're able to take advantage of globally looking for relative value in higher yields across the globe through investing in foreign bonds, non-U.S. bonds. Today, they have a pretty significant allocation to emerging market bonds, and then and a fairly significant allocation to non-U.S. developed market sovereign bonds, and then also U.S. Treasuries and agencies. But introducing that. The third component is this absolute return, and you've had absolute return hedge fund strategies for over since 2006 is when you initially implemented PAMCO, and it's for all these reasons, the same reasons that we talked about. And at that time, really within the hedge fund space, strategies like PAMCO, which is a fund of funds, they're investing in multiple underlying funds. The underlying funds that they're investing in different than long-short equity, what you're getting in Mauna Kea, in that they tend to be less what we would describe as directional movement of the market. It's intended to have bond-like risk, volatility, and provide a premium return to bonds. Over the last really 7 to 8 years, for the most part, there's been an evolution in the market into what we describe as liquid absolute return strategies. These are more traditional bond managers that are investing in primarily bonds, almost exclusively bonds. They're unconstrained to a benchmark, but there's much more transparency, lower fees, and daily liquidity versus the hedge fund model where you have quarterly liquidity. The volatility's been low, but you can have pretty wide tails. We think this is, by making a change to liquid absolute return from the hedge fund absolute return, you're getting a number of benefits. Lower fees, similar risk return profile, more transparency, and daily liquidity. And this has just really been an evolution in the market. So that's what we're showing. There's this book that I won't go through every page because the objective is really to narrow down candidates. Our research team is constantly vetting managers in this space, as well as others, and we've narrowed down to a list of 3 potential candidates for your consideration. And if you looked at page 4, the 3 candidates are listed here. J.P. Morgan, name that you guys should probably be familiar with, their Strategic Income Opportunities Fund. It has about $14 billion in assets in this strategy. It's offered through a daily valued mutual fund. The minimum is $15 million, and the fee is 54 basis points. So you can see right away, relative to the hedge fund of funds, it's a much lower fee structure, daily liquidity. PGEM, which is the subsidiary of Prudential Financial, a large fixed income manager, $3.3 billion in this strategy. Again, a mutual fund, very low minimums, which isn't an issue here. A little bit higher expense ratio at 65 basis points, and then Voya strategy out of Atlanta, and they have $3.1 billion in this strategy. So those are the 3 candidates. I think the best page to look at for the potential fit within the portfolio is page 6. So first of all, what's different about these types of strategies relative to what you have today? Much like Brandywine and Western, your Core Plus and your Global, these managers are going to have the flexibility to invest anywhere in the bond market. U.S., non-U.S., investment grade, below investment grade, floating rate debt. The one thing that they're going to do a little bit differently, and one lever that they have, is they can go short securities, and they can also use derivatives to create hedging against certain risk, interest rate risk being one of them. Generally speaking, you're going to see their duration move much more than your traditional bond managers, your Core Plus, and even your Global manager. Their duration or interest rate sensitivity is generally going to be that of the benchmark or pretty close to it. These strategies are going to really move that duration around based on hedging out some interest rate risk. So last year, these strategies trailed traditional bond strategies because they had such low duration, low interest rate sensitivity. You'll see that on the far upper right, the third row down, you'll see there if JP Morgan's effective duration is 0.39 years, which is almost no interest rate sensitivity. And the reason for that is they hold 40% cash at the end of the year. So of these three managers, JP Morgan is the most different, and it's really what the manager of this strategy is doing. He's very contrarian. He is going to be going from cash to high yield in major swings when he determines there is opportunity there. So right now, and really for the last year or so, it's been pretty heavy allocation to cash or short-term investment funds, and very little, the corporate exposure is in very short-term corporate paper. Just to get this off the table, because I'm trying to narrow it down to 2 or 3, we like this firm and this strategy a lot, but within your portfolio, the Western strategy, it's core plus, which means they have the ability up to, in this case, in this particular fund that you're in, 40% can be outside of the Barclays aggregate, Bloomberg Barclays aggregate index. When opportunities arise in high yield or below investment grade, you'll see this Western strategy really load up on high yield, which would be a similar thing to what JP Morgan is doing. So you may be doubling down on that. Bottom line today, because we're not picking a manager, if we're trying to narrow it down to 2, I would suggest that the Prudential and the Voya are better either one of those are better complements to what you have currently than the JP Morgan, even though we like that strategy a lot, just looking at what you have today. So our recommendation at this point would just be to bring those 2 in to interview and consider as replacements for PAMCO. Just, and not to belabor this, if you go to page 8, even on page 7, I think we can see it. Page 7 is probably good. So page 7, we have performance here. At the top of page 7, this is all periods. On the left is 1, 3, 5, and 7-year return, then 3, 5, 7-year standard deviation or risk. Again, what we're trying to get out of this is fixed income-like returns and fixed income-like volatility. You'll note 2019, all of these strategies are red, meaning they underperform the Barclays aggregate, which we would expect. In a period where rates come down dramatically, these strategies that are designed to really hedge out a lot of that interest rate risk generally aren't going to perform as well. But you can see the liquid strategies actually did a little bit better than the hedge fund strategy, and really over the last several years. The one big differentiator when we look at PAMCO on the hedge fund side, if you go to page 8 and go back and looking at rolling 1-year returns on the top of page 8, these are 1-year distinct periods, really got a big boost in 2012 and 2013. 2013, we saw a big rise in rates. That's when rates really started to tick up over 3.5%. So they got a little bit bigger leg up than the liquid strategies, but also they had a little bit more volatility and some, it wasn't pure equity, but some equity exposure in these, in the hedge fund strategies. So as we look at it one for one, saying, well, we're swapping out illiquidity for more liquidity, are we giving up a little too much return? Perhaps in a year like 2013, but over time, we think the return is and risk has been what we're really looking for in the fixed income space. So we think this is a good trade-off. Similar risk and return within the asset allocation, lower fees, more transparency, daily liquidity. I don't know that this is a motion at this time, but we would recommend that those 2, Prudential and Voya, be brought in. Sure. You have within the fund strategies. And where are you looking at right now? Mm-hmm. So that. Well, for Prudential, the high yield is 19.8 right now. I'm not sure where you're looking. Below investment grade. So the high yield is, if we look up above, the high yield is about 20% right now. But they could go up, even the Western portfolio can go up over 20% in high yield. But yeah, so there is a significant amount, even the Western, and if you look at Western here, that 9%, there's more than 9% in below investment grade at times. This is 144A private placements. So it is a little bit deceiving. They're just not rated securities.
Labor the point, but what's a 144 non-rated? Just
oftentimes now when companies come to market with bond issuance, they can get them issued quicker without going through a rating process. So they issue what's called a 144A private placement, and it's not rated by a rating agency. Bond managers, and that's what we're paying your bond managers to do, is to evaluate the credit risk. So when you have a qualified professional asset manager and you're an investor with over $100 million, you can invest in these private placement securities. So in the institutional marketplace, it's pretty common. In the retail space, it's less common because retail investors can't invest in private placement securities.
So we're relying on the expertise of our individual investment
Which
managers.
I would argue that's what we're not relying on rating agencies
Right.
in any case. It's just something that you're able to use for guide rails, but we're always relying on the investment manager's credit expertise in evaluating what securities they're going to own.
But of the 46.2% for PGIM, how much of it's not rated and how much of it's...
I don't have that here, but just looking at the high yield, if you go up above and you look at high yield corporates is 19%.
Okay.
So I don't have a breakdown. We can get that for you. And that can be something that we drill down on.
We can ask them next month, or when
Yes.
they come in.
Yes.
Any other questions? We've got a recommendation, the chair will entertain a motion.
Well, how many are we selecting and who?
Yeah, you got to make a,
Our recommendation would be to interview two,
right.
Prudential and Voya.
Motion and a second on item 15C. All in favor? Aye. All opposed? Motion carries. Okay. Item 15D is to approve the ERS pay plan with a 1% adjustment and a one-time $200 stipend retroactive to July 1, 2019. A little bit of background. The City Council recently approved adjustments to the pay plans. Help me, Francis, was it a couple months ago or
Yes.
very recently?
December.
Okay, so a month and a half ago. So all this item does is make the ERS pay plan the same, consistent. So, And the $200 stipend was approved to help offset the cost of some insurance increases that the city's experienced this year. It's a one-time $200 stipend. So, Chair will entertain a motion.
Move the item. Second.
I have a motion and a second on item 15D. All in favor? Aye. All opposed? Motion carries. Okay, now we are going to jump back to item 13 and ask Louise to come forward and give us our summary of the assumption study.
Good morning.
Good morning.
Does everyone have a copy of the experience study report? Great. Thank you. Well, I'm pleased to be here this morning, although I must say it was a lot colder than I thought it was going to be. It kind of reminds me of home. I'm going to talk about the results of the most recent study of retirement system experience. And I think during the course of the presentation, it might make things more interesting, if that's even possible with an actuarial presentation. If you ask questions and make comments during the course of the presentation, that way it may be more like a discussion and less of a formal presentation. I will do my best to make this interesting, but the nature of the material is such that that's a challenge.
You always do a great job.
Thank you, Paul. So each year we perform an actuarial valuation of the retirement system, which includes an assessment or calculation of system liabilities. And in order to do that, we not only use data about the people in your system, how old they are, their gender, how long they've been working for the city, how long they've been retired, but it also relies on assumptions about future events, when people will retire in the future. The decision to retire is far more complicated than just being eligible. Rates of investment income in the future, that's a big assumption. It has a big impact on results. Rates of termination and life expectancy, those are probably the key assumptions, but there are other assumptions as well. And assumptions, things change over time, and assumptions should be reviewed and updated periodically to account for that. I think the last study that we did was 7 or 8 years ago. And so here we are today to talk about the results of the analysis. And starting on page 2 of your report, we have the first assumption, or decrement, if you will, and that relates to the incidence or probability of retirement, regular retirement. So as you know, in your system, if someone is at least age 65 and they have at least 5 years of service, they can retire and collect a lifetime pension benefit. But also, if someone has at least 25 years of service, they can leave and collect a pension as well. And so we looked at, so the analysis summarized here shows what was expected based on actuarial assumptions, and then what actually happened during the 5-year study period. And these are plan years from 2014 to 2018. And so what you can see consistently throughout the period is that the actual number of retirements, people retiring, is lower than what was anticipated by actuarial assumptions. So people seem to be sticking around longer, at least at these higher service and age levels. And so this suggests a need to lower the probabilities of retirement to better align the two. And the impact that this has on system liabilities is that it actually lowers the incidence, it lowers the magnitude of liabilities. And that's because you aren't paying people out for a longer period of time. If I retire when I'm 65, then you're going to be paying me out for 20 or more years. If I retire at 70, then you're only going to be paying me out for 70 years. That's generally the impact. And that's offset slightly by, additional accruals based on additional years of service and pay increases, but it's usually that longer payout period that adds the cost. So by reducing the probability of retirement, reflecting the fact that people are sticking around longer, it lowers our assessment of system liabilities. And on the following page, page 3, we also looked at the incidence of early reduced retirement. So in your system, like many public employee systems, people can retire early, but their benefit is reduced to reflect the fact that they're getting more payments. And Social Security works this way too. If you can retire at 66 with an unreduced Social Security benefit, but you choose to retire at 62, your benefit is actuarially reduced to reflect the fact that you're going to get more payments. You shouldn't profit from that. You should be treated the same way as someone retiring at 66. And in your system, there is also an adjustment. So if someone retires at 55, their benefit, instead of 65, the benefit is reduced by 4% for a 10-year period. Again, to reflect the fact that you're going to be getting more payments than someone who leaves at 65. A 4% reduction actually isn't an actuarial reduction, but these are your retirement plan provisions. And so again, what we see just looking at the 5-year study period is that, people who could retire, they seem to be sticking around at the city longer. So we're seeing a lower incidence of retirement than what was anticipated by assumptions. And so the recommendation would be to, again, lower the probabilities of early reduced retirement to better reflect what seems to be happening at the city. And on page 4, we have shown in probably painful detail what these probabilities are. So on page 4, if you look at the far left, the 2 columns where it shows the age of the member and the percent of eligible members retiring during the years. So this means that if you had 100 people age 55, for example, and they all had at least 5 years of service, but not 25 years of service, that the probability of these people retiring is 6% between 55 and 56. So if that happens, it means in the first year you'd have 94 people left. The probability of retiring between 56 and 57 is another 6%. So then it gets ratcheted down by another 6%. You end up with 88 people, and so on and so forth until eventually you don't have anybody left. And so that's kind of how it works. The decision to retire is really far more complicated than I'm eligible, I'm ready to go. I think that's true for some people, but it's generally not true overall. So we model this by using probabilities of retirement based on age and years of service as well, which is shown in the next 2 columns. And so you can see, just looking at the far right, the proposed tables, they show a reduction in those probabilities between 55 and 65. And for people retiring, the very last 2 columns on the far right, you see a reduction in the probabilities of retirement, really after about 26 years of service. On page 5, we also looked at the incidence of, I'm sorry, Brett?
I just want to make sure I understand this. So,
sure.
When you look at, for your age 55, the percent retiring, our current assumption is 15% of the people will retire.
At 25 years of service.
At 25 years of service,
Yep.
15%. And we're keeping that assumption the same on the proposed rate. Then on the next year, instead of it being 10%, 9?
Mm-hmm.
Okay, so forth. Okay, just want to make sure I was doing the math right. Okay.
You got it right.
And so what you did in like the next 5 years there, you reduced it by 1 all the way down to 69. For each year where it was 10, you reduced it to 9%, roughly?
For up to 45 years of service.
Yes.
Which we don't see too many people at the city working that long,
Right.
but it's certainly possible. Exactly.
Okay,
So-
I just want to make sure I understood it properly.
You got it. You got it. And it seems like a small increase, and so the idea is really to move in the direction of the change. We never assume that the future will be replicated perfectly based on the past, and that would potentially lead to a lot of choppy results, which would make it very difficult for you to budget. So we're mindful of that. Other questions? On page 5, we also looked at termination, which is really the event where someone leaves city employment or potentially they're asked to leave, and for reasons other than retirement or disability or death. So generally, these are people who quit. And in your system, and this is not an uncommon provision, if someone quits after having 5 years of service, as long as they keep their money on deposit with the retirement system, they can elect to receive a pension benefit in the future. And so when we looked at what was happening with termination rates, we looked at people who quit with at least 5 years of service, but not 25 years, and they were below age 65 or 55. And then we looked at people who quit with less than 5 years of service. And what we found was, again, favorable. If you look at the two charts on the bottom, on the far left, vested deferred terminations, these are people that quit with at least 5 years of service. And what you can see is that there's actually there's a significant increase in the number of people who are quitting relative to what was assumed. So although people at older ages with longer service are sticking around, during the study period, there was a higher incidence of termination than what was anticipated. And so this suggests a need to increase the probabilities of termination. And that has a favorable impact on system liabilities. So to the extent someone quits and they forfeit future benefit accruals, it's good for the system because our assessment of liabilities is lower. It's lower because the benefits these people are getting is lower. They're getting less in benefits. And when we looked at people terminating with less than 5 years of service, what we noticed is that the highest incidence of termination, or most people were quitting with less than a year of service. And that makes some sense. I guess people generally figure out pretty quickly if they want to work someplace, and if they don't, they leave. And then it tapered off pretty quickly, decreasing thereafter. So for people with between 1 complete year of service and 4 but not 5 years of service, the incidence of termination seemed to drop as service increased. But again, higher incidence of termination. So the recommendation would be to increase the probability of terminating in that first year of service. This also has a favorable impact, but probably less of an impact than the vested deferred terminations. It's because you only have a year of service. You haven't earned anything, really, not much.
I had another question. I know if somebody comes and works for the city for 2 years, doesn't vest, and quits, they can get all the money they've contributed out of the system, and then we pay them interest, right?
Yes.
How much of that, what is the rate that we pay them?
Good question.
The board decides that each year based upon the 2-year Treasury yield.
Okay.
So it's been about 1.8.
It's nowhere near our 7.17%.
Correct.
Okay, that's what I assumed, so just want to make sure. Thank you.
That's a good question. We work for a lot of systems where that amount actually isn't tied to a Treasury yield. It's like a fixed 3%. So that's a good decision on the part of the board. Some people will get upset. They'll say, "You're giving these people 3% on their money? I can't get that." And then on the page 6, we have the probabilities of termination during the first 5 years. It's years of service is actually complete years of service. So if you have 6 months, you have 0 years of service according to this chart. If you have 4.5 years, you have 4 complete years of service, with a reduction, an increase in the first year and kind of tapering off thereafter. But you can see a much higher rate of increase for people with more than 5 years of service. And for those folks, it's really tied to their age. You can see that the probability of quitting starts to drop as you get older. It's just people tend to stick around at older ages.
Just so I understand this too, really, when you're looking at this, year 0 to 4, your proposed adjustments actually help from an actual standpoint.
They do.
But when we go below that, it requires more of the system.
No, actually, so, I'm sorry, so between 1 and 4, yeah, that's true, but in terms of impact, that's small. When you get to 5, there are a couple of things going on here. So between 0 and 4 years of service, what happens is when you have a higher rate in the first year, it kind of wipes a lot of the population out. And then it is there are some reductions between 1 and 4 years of service. They're relatively small. When people have 5 or more years of service, you can see that's a fairly big increase. It's about a 90% increase. And here is where you're going to see the reduction in liabilities. I have 5 years of service. I'm entitled to a benefit. The longer I work, the bigger the benefit I have. But we're seeing overall an increase in rates of termination. So overall, this package of proposed assumptions, along with retirement, actually lowers our assessment of liabilities. And on page 7, we also looked at the incidence of disability. And specifically, we looked at people who were disabled, applied for a disability retirement, and then received it, which is a little bit different than just being too ill to work and then leaving. And the incidence of disability in your system is relatively low. It looks like about 3% of all retirees are disability retirees. And usually this means that it becomes a function of how the disability benefits are administered. We work for some systems where almost anyone qualifies for a disability just based on the way the program is administered. And then it's sort of a continuum. And then at the other end, you have to be half dead to get a disability benefit. But there's a low incidence of disability retirement elections in your plan. And because it's so low, there really isn't enough information here for us to make any recommendations related to changes. And in terms of impact, this assumption has a relatively small impact on liabilities and the valuation overall. On page 9, we have the mortality assumption, which actually has a bigger impact on system liabilities. And mortality measures the probability of dying, and since you're either dead or alive at any point in time, we know the probability of death at a given age, then we know the probability of surviving a year at that age. And so actuaries use the mortality assumption to determine life expectancy, which helps us to understand how many payments we expect to make to retirees during their retired lifetime. And that's where it has its biggest impact. Probability of dying as an employee is relatively low. It has a very small impact on system liabilities, as does the probability of a disabled person retiring. It's really healthy life retiree mortality that is a big driver of cost. And so in your system, what we're seeing is you have about 1,600 retirees, but that really isn't a big enough population for us to use it as the basis for determining the mortality assumption. The data isn't what we call fully credible. And probably the easiest way of describing that would be with like an oversimplified example. If you had a one-year study period and you had two twin brothers in a company and they were both age 55, and during that study period one of them died, if you used only the system's experience, one of them lived, one of them died, two of them could have died, you'd have a 50% chance of death at age 55, which is ridiculous. I would have been dead a while ago. So the credibility of a group that size it's just not credible. And even though you have 1,600 retirees, the data just isn't fully credible. So what we do is we looked at the OPERS system, the Oklahoma Public Employees Retirement System. It's the largest system in the state that would be comparable to your system. They have about 35,000 retirees. And the report was well done. There was sufficient detail in their analysis to enable us to see what was going on. And the table that system was using and your system was using was RP 2000. So there have been 2 new tables published since then, projected to 2010. And what the analysis shows is that there's been some improvement, but rather slight. So the OPERS actuaries recommended and the board adopted the RP 2014 Mortality Table, which was published or produced in the year 2014. And they're recommending a blue-collar version, which has lower life expectancy than some of the other versions of this table, like the white-collar version. And based on that analysis and the similarity in your populations, our recommendation would be to update the current mortality table to RP 2014. And you can see what this means in terms of life expectancy on the following page, on page 10. So at the top of page 10, you have the current assumption, so life expectancy based on this older RP 2000 mortality table. So a man age 50, based on that table, is expected to live another 31, almost 32 years. Under the proposed table, they would be expected to live 32.87 years. So we got a 1-year improvement there. And roughly a year at 55, we're just showing sample ages here, generally improvement. You can see for females that the improvement is a little bit better. Women still continue to live longer than men on average, even though the gap is narrowing. When you look at data from the 50s, the gap was a lot wider in terms of life expectancy, with women living much longer than men. And over time, it started to narrow, which is kind of interesting. But women are still living longer on average. So our recommendation would be to update the current mortality table to RP 2014. I think it's probably worth pointing out that there's still a newer table that's been published. It's called Pub 2010. It's actually a suite of tables. There are about 100 different tables. And it's based on an analysis of public employee data from across the country. So the Society of Actuaries, they're collecting data from the California Public Employees Retirement System, statewide systems in Oklahoma, systems in Michigan, Illinois, just all over the country. And then they do an analysis of rates of death among retirees as well as other populations. And those tables show improvement generally over RP 2014. When we looked at everything, the more reasonable assumption seemed to be the RP 2014. Going to Pub 2010 at this point, I think, would have been very conservative. It would have added a lot of cost relative to, I think, what we see in general for life expectancy in Oklahoma. And life expectancy in your state, it's not as great as what we see in other states. Michigan, New York, Illinois tend to have better longevity than what we see in Oklahoma. Sorry to report this. But better life expectancy than what we see in states like Mississippi, where it's really bad. Mississippi, Alabama, life expectancy just isn't as great. So it's kind of interesting. There are regional differences. Great improvement in life expectancy in the Pacific Northwest. Not exactly sure why that is, but that's what it seems to show. On page 11, we have a review of some actuarial methods. As you know, we amortize unfunded accrued liabilities, or to the extent you have credits, those are amortized as well. Currently, we're using a period of 23 years, which I think continues to be reasonable. That period, is reduced by one each year. The cost method is really a technical methodology that splits total system liabilities into past service and future service. It enables us to calculate contributions. The method we're using is the most common method used by public funds. We wouldn't recommend any change to it. The asset valuation method or asset smoothing method, the only recommendation would be to add what's called a corridor to the smoothing method. And if that had been in place over the last 5 to 8 or so years, you wouldn't have seen any difference at all. It would have had no impact at all on the results of the valuation. But the purpose is to keep the smoothed value of assets from straying too far from the market value. So, for example, when we entered the Great Recession in 2008, all investors, including the retirement system, had significant investment losses. And so what happens when you have investment losses for significant ones or losses for a period of time that add up to be significant is that the smoothed value of assets becomes inflated relative to the market value. And it's because you're not recognizing all of those losses at once. You're holding some of them back. So naturally, the smooth value of assets is inflated, and then over time it tapers off as you recognize the losses. The concern we would have is if you had, and I really hope this doesn't happen, another black swan event and there are horrible losses, that when the asset value becomes superinflated, contributions to the system become understated. When you inflate assets so much, you're not recognizing all the losses, the asset value is too high, contributions start to drop, and they end up being potentially too low. So our recommendation would be to, in an instance like that, constrain it so that it's within 20% of the market value. It also works in the other direction. For those of you who remember the late 90s and the booming investment markets, you have the same thing happening, except instead of the actuarial value of assets being inflated, it's actually deflated because you haven't recognized all the investment gains. But it would work in the same way. Except nobody really cares in times like that. Everyone's just happy that, investment markets are booming. I know you remember that, Dennis. In terms of the economic assumptions, the discussion begins on page 12. The board has made great strides in reducing the assumed rate of investment return in the future. And currently we're at 7.1%. The economic assumptions include a price inflation assumption and anything related to price inflation, which would be investment return, price inflation itself, and wage inflation. Currently, the assumed rate of price inflation is 2.25%. And in setting this assumption, we look at a number of things. We look at the Social Security trustee report. Social Security has an army of actuaries, and they do all sorts of projections and pricing. Their price inflation assumption is very long-term. It's like 2.6% over a very long period of time, I think about 75 years. But we also look at the Federal Reserve banks. What are they projecting price inflation to be? And it seems to be hovering around, well, 2.2% for the Philadelphia Reserve, but 2 to 2.25% seems to be the consensus there. And so as a result, we're not recommending any changes to the price inflation assumption. 2.25 seems like a reasonable rate. In terms of wage inflation, the current assumption was 3.25%. We would recommend lowering that. So lowering wage inflation has a favorable impact on system liabilities. To the extent that people are getting lower assumed pay increases in the future, our assessment of retirement benefits in the future is lower because your pay isn't going up by as much and your benefits are related to pay. So our recommendation would be to lower that down to 3%. The next 2 pages show 13 shows some historical information related to price inflation and wage inflation. Page 14 shows the current asset allocation for your system, how you're invested, which is a key consideration for setting the investment return assumption. So you have a nice diversified portfolio. On page 15, we have the results of some analysis that we do. And what we do is we collect information about capital market expectations in the future from 14 different investment experts. Many of these companies are investment consultants that provide counsel to public employee retirement systems. And they let us use their data if we preserve their anonymity, which we've done here by identifying them as numbers 1 through 14. But they include companies like JP Morgan, Aon, I think RV Coons is included here. And so what you can see is the results of the analysis. And basically, what you're looking at here is the answer to the question, what would you, Mr. or Ms. Investment Consultant, expect this portfolio to earn over the next 20 years in terms of an average rate of return? And you can see that there's variation among the 14 investment consultants. Just looking at column 2, this is the nominal rate of return. It would be comparable to your 7.1%. You can see there's wide variation here from 5.73 up as far as 8%, with an average being pretty close to the system's current assumption. The average rate of price inflation is pretty consistent with the assumed rate that we're currently using in column 3. The expected real rate of return is really it's column 2 minus price inflation. So the way most actuaries develop this is that nominal rates of return are price inflation plus a real rate of return, which is what you as investors are being compensated for by taking on investment risk. And so at the high end here, the expected nominal rate of return on average ends up being about 7.08%. The standard deviation is a measure of volatility from one year to the next. When we look at the bottom chart, so the way this analysis is done is you run thousands and thousands of trials. And because you have so many trials, you can use percentile rankings to determine the probability of achieving a given result. So the 50th percentile shows an average over a 20-year period of 6.35%. So a 50-50 chance of exceeding it or falling below it. The 60th percentile of 7.05%, 60% of the results would be expected to be below 7.05%. And so we can also determine the probability of exceeding 7.1%. So that could be 7.11%, 7.12%, 8%, 9%. And it's just under 40%. So it seems that a reasonable course of action, we believe, would be to lower the assumed rate of investment income. Because the way you're going to pay for these benefits is with member contributions, city contributions, and importantly, the investment income that they generate. And on the page 16, I thought it would be helpful to just show the net nominal returns over the last 5 plan years. On page 16 at the bottom, and near the bottom of the page, the chart, what you can see is that the markets have been volatile. And this isn't unique to your portfolio. This is consistent with what we see for lots of public funds. You see in 2018 a negative rate of return. 2019 you probably had a great rate of return. 2017 a great rate. 2016 falling below long-term expectations, but not horrible. 2015 negative. 2016 a positive number again. But for the 5-year period, the average has been about 4.6%. So we've talked about a lot of analysis and recommendations, and then certainly the obvious question becomes, well, what does this do to retirement system liabilities, and what does this do to city contributions? And that's shown on page 18 of your report. And so this chart shows actuarial results of both the current and the proposed assumptions using the most recent actuarial valuation data, which was as of December 31st, 2018, excuse me. And column A shows the results of the most recent actuarial valuation. And you see the system's accrued liabilities at over $730 million in row 1. The assets are what they are. The funded ratio, 99.6. Column B shows just the impact of changing mortality, retirement rates, and termination rates. And you can see that there's an increase. And the driver here is the mortality table. And the expectation is that, if this were implemented for the 2018 valuation, the funded ratio would be at 95.4%. In row 6, we also tried to give you a sense of what city contribution dollars would be. And it's a little difficult to do this because the 2018 valuation creates contributions for the city's 2021 budget year. We don't have payroll yet. Payroll in your plan can be tricky to estimate. It seems to vary depending upon the population of city employees and the pay increases that they receive. But a rough estimate would be $9.6 million under the current report, which we're not recommending you change, to $10.8 million potentially, with the understanding that that could be very different. Column C shows the impact not only of updating mortality, retirement, and termination rates, but also lowering the investment return assumption by 10 basis points down to 7%, and then lowering the wage inflation as well. And you can see, looking at row 1, that the increase is modest. So lowering the investment return assumption raises our assessment of liabilities, but lowering the investment return assumption increases liabilities. Reducing wage inflation lowers them. And so the impact ends up being about a $5 million increase in liabilities and a relatively small reduction in the funded ratio. Another set of assumptions for your consideration is assumption set D on the very end, and that would be about a 35 basis point reduction in the investment return assumption down to 6.75. And you can see the row 1, the increase in system liabilities and contributions, and then the corresponding funded ratio. From our perspective, C or D, both would be acceptable to us. This is a retirement board decision. We would be comfortable with either one. And I realize this is a lot to take in, and you may want to study it, and I'm happy to meet with the board or the study session again to respond to questions and in detail.
Well, first of all, I'd like to say this is a great report, and you do an excellent job explaining this, and it's very thorough. I would like to see if we could, before we make any changes, take this back to the design committee so we could have a working session with you to talk about everything. And because this is it was extremely important to all of us. So
Yes.
I would, and this is a lot to digest in 48 hours. So
Yes.
it's good stuff, though. I love it. It's good stuff. I'd like to have a little bit more time to digest it if I could.
Understood.
So, excuse me. So, we've heard from Brent, and he and I spoke a little bit late yesterday and today, and I don't disagree with him that it might be helpful if within the next week or 10 days or even 2 weeks at the latest that we convened a meeting of the Plan Design Committee, which consists of Renee, Wiley, myself, Jim, and Brent, and we could get Louise on a conference call, and she's graciously agreed that if we want her to come back, that she will. I don't know that that's absolutely necessary, but we'll make that decision at a later point. If that's the pleasure of the board, we would need a motion to defer items 15E through 15J to March 12th. We would need to make a decision on those recommendations at next month's meeting to allow Louise and her firm time to begin work on this year's experience study. So
that would be correct. If we adopted these in March, we would apply them to the December 2019 valuation. And that would be the time period we would need to allow you to complete the 2019 valuation in a timely manner and do it in March. Correct?
Yes.
okay. So Brett, if you'd like to make a motion to actually defer items E through J with the intent of convening the Plan Design Committee, and we'll address those next month. That's what's on the table.
And I would like to make that motion to defer these items to the
Okay.
Plan Design Committee.
Okay, we have a motion to defer items 15E through 15J for further study, and those items will be brought back to the board at the March 12th, 2020 meeting. So we have a motion and a second. All in favor? Aye. All opposed? Motion carries. Okay, so now we are on item 16. Pardon me? I'm sorry. 15K. I'm all out of sorts this morning. Item 15K is to approve a contract between the Oklahoma City Employee Retirement System and Independent Medical Examinations LLC, retroactive to January 1st, 2020. This is our contract with our medical firm that when we have disability retirement applications, we use them to provide us a recommendation. Chair, I'll entertain a motion.
Move the item. Second.
I have a motion, a second on item 15K. All in favor? Aye. All opposed? Motion carries.
We do need to receive the study.
Okay.
That was submitted.
Okay. Jumping back once again, we need to take action on item 14, which is to receive the assumption study.
Move the item. Second.
Motion a second on item 14. All in favor? Aye. All opposed? Motion carries. Okay, I think we're back in order now, and we are on item 16, investment consultant report.
Sorry.
Okay.
Clarifying a couple things. So I'll try to be brief here. You have the January report and also the year-end report that I'll refer to a couple pages, 30 and 31, if you just want to turn to those pages in the quarter report. Just to add on to Louise's comments, as we've made a few tweaks to your asset allocation. So on the flash report, this target allocation in the middle of the page, as you know, that is your long-term target asset allocation. So when we're talking about what the expected rate of return is over time and the probability of achieving that, this is the target we're looking at. And we just addressed this a few months ago, where we made a few tweaks, principally eliminating the target allocation to commodities, which was 5%, and reallocating that to opportunistic and core real estate. So as you see on here now, the real asset target is still 15%, but there's no longer a target to commodities. You still have that position in commodities we haven't redeemed yet because we were waiting. You put in an additional subscription to Morgan Stanley Prime Real Estate Fund, and they expect to be calling that probably in March, so we're going to put in for that full redemption from commodities at the end of this month, so that will be going away. Our capital market assumption analysis, you may or may not recall, but looking at over the intermediate time horizon, the next 5 to 10 years, our return expectations are more muted, so probably in that 6.5% range. As you move further out in time, 20, 30 plus years, we're going to look at return expectations that are more in line with historical normal, but still a little bit lower than we've seen over the last 40 or 50 years, just because where we are in terms of interest rates at a 2% yield. So I don't know if we're in those numbers that Louise presented, but that's the same numbers that are similar to the numbers that we're showing you. So if we look at the overall allocation, you continue to be at or near targets in the broad asset classes. Within equity, a little bit more overweight to large cap U.S. and small cap, as those have been the best performing asset classes. As we've been needing to raise money for benefits or operations, that's where we would raise capital from. With the return of the commodities, $23 million, which will probably happen in the first week or so of March, we're going to need to reallocate some of that. It's not going to line up perfectly with the funding of the $9 million subscription to Morgan Stanley. That'll probably take place over a couple of months. So most likely, we'll want to reallocate that in your liquid, very liquid index strategies, both on the fixed income and equity side. And so we'll work with staff to do that. Turning to the second page here and just looking at results. So January was, we came off of a record-breaking year in 2019, and as we sit here this morning, this February has been a good month. January, we saw some give back in the equity markets. The total portfolio was down about a little less than 0.5% for the month, but the one-year return at the end of January was a little over 13%. The calendar year return, which is when you're measuring from an actuarial standpoint, if you look on page 30 of the quarter report, was a little under 20%. 19.6% was the total portfolio return for calendar year 2019. So very good return overall. A little bit behind the policy index. When you're up that much, you've got some insurance built in. The long-short equity, private equity aren't going to track the long-only equity markets, which that's what's in the benchmark. Relative to other public pension funds, the median public fund, which is that IM public DB gross, was up 18.45%. So about a full 1% premium over the median public pension fund over that time period. So ranking in the top third. Peer group rankings over 3, 5, and 10 years all look very good. Top quartile to top third over all periods. Most importantly, I want to look at page 31 because we talk a lot about this. The objective, you're been close to a fully funded plan for some time. So the portfolio is structured in a way to generate the highest rate of return with an amount of risk that's a little bit less than the markets. We want to have a high probability of achieving that required return over time, but also want to be cognizant that markets go up and down. If you look at on page 30 in the bottom left, we have the calendar year returns, and this is what Louise was referring to. So going back 5 years, there's been a lot of ups and downs. It feels like it's been a nice smooth ride from 2009 through 2019, but you can see 3 or 4 years of negative returns and a couple of years in there where you got returns right around your 7%. So smoothing out those declines is really important, and your portfolio is structured in a way to try to do that. So you may not capture all of the upside when markets are going up, but we're also not capturing all of the downside. And by being down less, when markets are down, your assets actually compound at a greater rate. I always like to use that example. If you're down 50%, you have to be up 100% to get back to even. Right? So by being down a little bit less, we compound at a greater rate. And so looking at the 10-year, on page 31, upper left is just a 10-year risk and return chart. And I know I can't decipher these colors in this light, but you're the square that's in the upper left, which means you're more return and less risk than your policy index or what the target allocation would suggest, which is really what we want to get over a long period of time. Looking at those other measures in the middle on the right side of the page, these benchmark relative statistics, we look at beta and up and down capture. So beta is sensitivity to the direction of the market. How sensitive are you to market going up or the market going down? Your overall allocation. The portfolio is really designed to have less sensitivity to just the direction of the market overall, which a beta of 1 means you have the same sensitivity as the market. A beta above 1 means you're going to be more susceptible to movements in the market. That 0.92 means you've got a little bit less sensitivity, so it's a better, it's a lower risk portfolio. And then those up and down capture numbers, they're actually pretty good over a 10-year period. 96% of the upside, so we're capturing most of the upside over that 10-year period, but only a little bit less than 90% of the downside. And that's where the long-short equity is designed to provide that protection. Some of your managers, higher quality, tend to protect in more declining markets. And then on the fixed income side, doing some things to mitigate against a lot of interest rate sensitivity. So overall, you're getting what we would expect to get. in the portfolio. Going back to the monthly report and just some highlights, in a very good year, what was helping, as I mentioned, overall on a gross basis, you're about 35 to 40 basis points above the benchmark. Your large cap allocation, while being overweight, U.S. large cap helped. The managers slightly trailed. The in-tech strategy, you're very benchmark risk controlled in large cap with a combination of in-tech, which is a enhanced index, and then the index fund. The index fund performed in line with the index. In-tech underperformed a little bit over that 1 year period, up well, actually they're slightly ahead in your index. Just on a net basis, they're slightly behind. What's happening with in-tech, generally, that strategy overweights the smaller names in the large cap universe, and when large cap, mega cap names outperform smaller companies, they tend to underperform. And you've got a little of that over the more recent period. Your small to mid cap allocation, which is a combination of Earnest and Times Square, has done very well. You're actually a little bit overweight there. So again, being overweight U.S. helped as U.S. outperformed non-U.S. And your managers did a fantastic job there. Times Square was your best performing manager as growth, both in large cap, small cap, was the best performing sector, technology in particular, and Times Square did a very good job. Growth has outperformed value over the last several years. 2019 wasn't any different. I'm just looking at page 2 of the ASAP and really just commenting on the composites. Earnest Partners, while value-oriented, and they were just here a couple months ago giving an update, they tend to not be very deep value, and in a period where growth is outperforming, they're doing well relative to their value peers. They were up 15%, and the benchmark was up 7%, so pretty good relative returns there. Long-short equity, we're pleased with the Mauna Kea platform, up 13% on a 1 year basis. It's hedged. We've got about 60% market exposure, but we're getting a little bit more juice than we were through the K2 Overseas Fund, which is what we're intending to do, but still protecting when markets are down. For the month of January, it was up 16 basis points when the ACWI global benchmark was down 100 basis points. International managers, both on the developed side, did well. So your international developed up about 14% relative to the benchmark, up 12.68. So both Harding Loevner and Lazard outperforming. And your emerging market, Wells, Berkeley Street, and Wasatch really outperformed. Wasatch is small cap emerging markets, up 30% in the year when the EM small cap index was up 2%. So significant outperformance. A lot of that coming from India and not having much exposure to China really helped buoy that return. So that's a small allocation. It's about a little over 1.4% right now in your portfolio. I think it's targeted for 1.5%. This is the types of periods why you have it. It's a return enhancer, but we also know how volatile it can be. It introduces risk. But you're really getting the benefit over this time period. The fixed income overall, I jumped over that because we talked about it earlier. Very good absolute returns from bonds, almost 8% over the trailing 1 year. Trailing the index, the Bloomberg Barclays Aggregate Index, which is much more interest rate sensitive. Your portfolio, the PAMCO component, and primarily, you don't have that interest rate sensitivity in the absolute return component, so that's underperforming a benchmark that is going up as rates came down. The return in bonds that you're seeing in the Bloomberg Barclays Ag isn't necessarily from a good story, right? In stocks, when stock prices are up, it's because things are going good. That bond index is up over worry, and a flight to quality, slowing global growth, very low yields and negative yields in foreign markets, pushing money into U.S. Treasuries, pushing down yields and pushing up values. So really, we look at 2019 within the fixed income space, and you're probably pushed about 2.5 to 3 years worth of return into 1 year as you push yields down. Overall, other than the things we've talked about earlier, no issues or concerns about managers at this time.
Anyone have any questions for Jason? Thank you, sir.
All right, thank you. So next month, is next month good to have the 2 managers come in? Okay.
I would think so, yeah. Okay. Plan on it. Item number 17 is comments from board, staff, and citizens. Again, I'd like to congratulate JC, thank everybody for their attendance so we could have the meeting, and Plan Design Review Committee. Oh, I'm sorry, Wiley.
That's all right. I did want to.
Oh, I'm sorry. You know that.
One thing to the board's attention. Our lawyers at Labaton and Sicaro in New York City have asked us to consider participating in a claim that they want to investigate, and I'm just going to read from their correspondence to me. They're investigating potential claims against a controlling stockholder of Santander Consumer USA Holdings. They believe Santander announced a tender offer to acquire approximately $1 billion of its own stock on the open market. The tender offer appears to be designed to provide Santander's controlling stockholder, Banco Santander, massive financial benefits while providing no benefit whatsoever to Santander or its minority stockholders. In particular, the following the tender offer, Banco will own more than 80% of Santander's outstanding stock, which according to Santander's proxy will save Banco hundreds of millions of dollars in annual expenses that can only be eliminated if Banco gets 80% of the company's shares. If it appears to be the case, Banco caused Santander to spend $1 billion in corporate funds solely to benefit Banco. Then Banco has breached its duty of loyalty to minority stockholders and is liable for damages. Santander and its minority stockholders would likely benefit from improved corporate governance reforms that will protect the company from Banco's influence going forward. They're not asking us to participate in a lawsuit. They want to represent that we are, as a potential minority stockholder, is interested in investigating the claim. And I didn't want to tell them we would do that unless you guys don't object. I don't mind doing it from my office as your lawyer, saying it's worth investigating to see what's going on. So if you have a concern with that, let me know, and I won't tell them yes, but okay. I think we should do it. And if they want to sue later, then we have the option to participate as a plaintiff or not. We're not doing that at this time. Yeah. We're just investigating.
Okay. Thank you, Wiley. Okay, as I was saying, the Plan Design Committee will reconvene here very shortly, and we will bring those items back on the March agenda for consideration. So, anyone else have anything? Again, thanks for your attendance so we could have the meeting, and we are adjourned at 11:40.